Is the 40-year mortgage a route to wealth or a debt trap?
It's just the next evolution in trying to allow new buyers to be able to afford current prices. But just because you take out a 40-year mortgage doesn't mean it's going to take you 40 years to pay it off. The minimum repayment is the minimum. Obviously, if you can afford more than that, you would just put the money either into the loan or into the offset account, and you would try to pay it off on your terms. They had to get rid of interest-only loans off owner-occupier loans because it was a bit of a risk in our system back in 2015. I think interest-only loans are going to come back in full force.
G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers. I'm here with Chris Bates from the Alcove Group, mortgages specialist. Chris, how's your week been?
It's been a good week, Pete. If you have been following along at home, which we're all very grateful if you are, but I'm an uncle now. I mean, I have got other sort of nieces and nephews through my dad's remarried and kids and all that sort of stuff. But, my sister, who I very close with, had a little baby girl last Friday night, all healthy. She's okay, my sister, and had a really good first week, I think, because as you can expect with the newborn, feeding well and all that sort of stuff. So, yeah, I'm absolutely, if you can't even see it on my face, you absolutely chuffed. We saw her in the hospital last Saturday and we go back to see her again on Saturday this weekend. And, super pleased. It was so cute. Obviously, Tommy and Ellie. Ellie's 5.5. Tommy's almost 4. And, I was so proud of my boy. Just got into the hospital and said, can I hold the baby, straight away, which was just amazing. So, super happy right now.
Oh, exciting times. My sister-in-law from the US is actually also due, but not till just after New Year. So the countdown's on there as well. But, it's always an exciting time when you get a new addition to the wider family. So congrats from this end. So what else have you been up to on the work front? A lot of the buyer's agents around the traps are telling me how busy it is, not necessarily with the volume of clients, but just trying to actually get properties bought. I know that certainly our team has missed out on a fair few in recent weeks with multiple offers going in some cases up to 20 offers. So pretty hectic, I think, buying conditions with so little stock around. But what are you seeing from a mortgage broking perspective?
It's a hard one to read at the moment, Pete. I think it's obviously there's first-time buyers in the market, right? And they're pretty strong. Obviously, the 5% deposits. It's not a great time to be a first-time buyer. It is in some sense because you're in the market, but it's also not good because there's a lot of other first-time buyers in the market and it's very low listings. It's already October, and so we've spoken about that lots. Yes, there's investors. I think, and I think this is kind of like a little bit of the canary in the coal mine. It's going to be part of our conversation today. We need investors in the market. I'm finding it hard when people are saying investors are the problem when, one of our stories today is talking about just there's no key worker housing in a lot of our capital cities because there's just no rentals and rental vacancy rates are really tight. Rents are reaccelerating. And I think there's a real problem here, an underbuilding of stuff that's actually more affordable. And so, the investors are there, but I just don't think they're often they're not going back, replacing where the old investors are. And their budget's a lot smaller. Upgraders are sort of very on tenterhooks. I mean, we had a client buy 6 mil plus last week. We've had, quite a few clients buy, 2 to 3 and, etc. Which we haven't had too many in the last few years. Let's be real. That part of the market's frozen up. But I do think they're on tenterhooks. And I think the rate conversation you can see through the AFR this week and just sort of feeling the confidence around it. I think people are going to want to wait and see. I think people are going to want to see what happens in sort of April, sort of March time next year when we come out of the Christmas bubble and we get in that first quarter of 2026. And, where's the rate expectations? Now, if they're saying a flatlining of rates for the rest of the year, I do think you're going to see still a frozen up market. But if there's and if there's rates going up, then that's obviously going to be even tighter market for houses. People are going to sit on their hands more. But, if the narrative around rates really shifts and it goes back to kind of what it was, maybe 2 or 3 more rate cuts coming, I think that will be the confidence the upgraders need. And so it's a really hard one to read at the moment. Definitely no mortgage wars. I mean, the papers have been writing, every soon as there's a change to policy, new mortgage laws are back. That's absolute nonsense. Pricing's actually got worse, not better in the last month, which goes against what you read in the media. It's actually, you're getting less discounts and less competition really on rate than we had a month ago. And so, yeah, it's a really strange market. I don't know what you're seeing, Pete, right, on the buying side, but I think it's tough to buy, and everyone's very price sensitive, I would say. They're not going gangbusters on every property, but they're just all flocking like a seagull to a chip to the good stuff.
Yes, and also the competition is largely at the cheaper end of the market. So, we certainly in residential property, we've got a couple of commercial property searches underway as well, but even that's pretty tight. I think a lot of investors have come back into the market over the past year. As you said, I think on the interest rate expectations, they've certainly been dialed back in recent weeks. We're recording this on Thursday morning, so before the release of the labour force statistics. So that will have an impact, obviously, on what's expected to happen with interest rates. But we're coming off a very weak month in the preceding month, and there probably would be a rebound you would expect. This will go out on Sunday, so you'll know by then. I think maybe some people are just a bit wary that interest rates might be kind of stuck around the current levels for quite a long time to come, and therefore repayments are still pretty tough. There was a couple of other bits of news earlier in the week. So firstly, the ABS put out the latest arrivals and departures figures, and over the year, 467,000 net permanent and long-term arrivals. So that's been rising now for 7 months in a row. You may recall there was a bit of controversy as to whether this sort of equates to what the immigration figures will show, because border crossings might not map exactly to immigration, but I think it's pretty clear that immigration is re-accelerated in 2025. That much is pretty clear. I suppose the other piece of stats, the other release that was out this week was just on dwelling starts and dwelling completions, and they were particularly low, really. I think if you look at housing starts, well, they fell back another 4% to about 45,000, and dwelling completions fell to about 40,000, lowest in 11 years. So when you think that in the context of a government target of effectively 60,000 dwellings a quarter, well, we're absolutely nowhere near that. We managed about 177,000 over the financial year versus a target of 240,000. So I think, there's quite a lot in the pipeline, Chris, but I think a big part of what's happening in this cycle is it's just taking much longer to build a house and a unit than it used to. It's a year now for a detached house, 2.7 years for an attached dwelling, particularly for a unit. And I think that's partly because in the previous cycle, we were building high-rise towers very quickly for overseas investors. This time around, it's a different quality and type of property. They're bigger units, they're more so for owner-occupiers, and the quality is much higher. So that's a good thing, I would say, for the market overall, but it is taking much longer for these dwellings to get out of the ground. And I saw Tarek Brooker, who's an independent analyst, said, well, let's look at some housing supply scenarios. There's definitely a case where if the dwelling supply picks up, by the end of the decade, we could be starting to address the housing shortage. But there's other scenarios where the shortage just keeps on getting worse. If you just think about those two figures as on a standalone basis, net arrivals of 467,000, permanent and long-term arrivals, and 40,000 dwellings in 3 months. It's a massive mismatch, and the housing shortage is clearly getting worse before it gets better.
Pete, I was just wondering your thoughts on this. I mean, there's a very aspirational target, right? 1.2 million homes over 5 years. Very unlikely that, and there's a kind of set this line in sand, right, where you said, like, well, divide that by 5 years, 240 dwellings a year. Yeah, there's no chance that we're going to hit that. There's articles all over the media right now, we're 70,000 short. And I wonder if it was always when they released that number, they knowing that they're going to not hit it, right? They're going to understeer to it. Then they're going to say, hey, now we need to do zoning changes. Now we need to really be pro-development. So maybe it was just setting this target that was really just a plucked number from the air, and saying that, and then that could be the reason that we're starting to see a lot more of this YIMBY movement. I haven't sent the article to you, but this Cathal Leslie is an economist. He's based in Paris. He did an article, Why Planning Reform Alone Can't Solve the Housing Crisis. And it is actually a really quite smart article, I felt. Basically what he's highlighting is that we don't have a dwelling problem. We have an allocation of properties problem, right? Lots of spare bedrooms, lots of properties that don't suit people's needs. And he says that the incentives around the way the property market is structured is it, right, disincentivize people to, get rid of properties that are too big for them, or to hold on to their house into the retirement years because it's not in the pension and it grows tax free, and etc. The other thing I would just sort of highlight on this, which I think's got a lot of merit, to be honest. I think the other thing I'd like to highlight is that there's a lot of people jump on this anti-development movement because they're basing it on the previous boom and the quality of properties that we built in the 20s or the noughties and the 2010s. And, I think it was when private certifiers didn't have to. In 1999, there was a shift. I'm not exactly sure of all the technicality behind it. It's not really my area, but basically you can see there's a line in the sand where the quality of buildings really deteriorated because certification. We basically built for investors. And, we'd actually probably like that in the market right now, actually, is a lot of investors building new stock. Not that I'd want to be the investor myself, but we need a lot more rental accommodation. And, if we could get some of that getting built, that would be good. Unfortunately, that stuff doesn't stack up. And if you go on real estate or Domain, whatever portal you like, and if then you go into look at new homes on the tab, then you go into the different states and you go look at the apartment buildings that we're building in New South Wales and Victoria, Queensland, all around the country. These are very, very high-end, architecturally designed, bigger apartments that suit either the family market or the downsizer market. And they're not sort of built cheap and cheerful to go up because that won't sell. There is a few of those sort of old school, sort of high density developments going on that are really big. And I don't know whether they're selling personally, but you can see the quality of the next run in I think properties getting built in our capital cities is going to be really match the streetscape. It's not going to be, crazy and just, horrible, really. I think we're going to be seeing a much. Now, there are going to be cases where people are going to feel it's over the top, particularly because in New South Wales, you can build a bit high because if you had a bit more affordable housing. And I think there is going to be cases where the community should really stand up. But, often a lot of these new apartments that are getting built, I feel that, it's what we need to be building. It's the missing middle. And even if it does just get a lot of downsizes, those downsizes have to come from somewhere. And so what you're going to do is start to freeing up some housing stock, and turning 6 houses to 60 apartments is not a bad thing.
Well, yes, I think you're right on the housing target. There's certain things in politics that are easy to announce, but difficult. There's certain things that are politically difficult to get through, but they're very easy to implement. So if you want to increase taxes, it's not going to be popular, but it's actually easy to implement. You just put in place the new tax rate and off you go. On the other hand, there's certain things that are very easy to announce, like a dwelling target, or we're going to bring in lower energy bills. But actually, the implementation is really difficult. If memory serves correctly, originally the housing supply target was announced in a Labour budget, and it was going to be 1 million dwellings, well-located dwellings over 5 years. Then it was clear that we were short of that target. And then suddenly there was a new announcement, it's 1.2 million, but nothing really changed on the supply side. It's proving more difficult than people might have expected to actually see that change. Because in the end, the market's got to deliver those properties. The government isn't really providing much of it. There's a couple of other articles related this week. One, housing shortage threatened by lack of tradies. Something we talked about last week. That was a Fin Review article. But yeah, a lot of young tradies are going to work on, for example, Victoria's big build project infrastructure, and they can get paid really good money to do that. So working on the residential side is probably less appealing. And also SQM research, rents re-accelerate as vacancy rates remain tight. So the vacancy rate fell to 1.2%. Sydney's vacancy rate fell to 1.3%. And vacancies are under 1% now in Brisbane, Perth, Adelaide, Darwin, and Hobart. So, and asking rents are now on the up again. So that could be a potential problem for the Reserve Bank. And it's another tick in the box, I think, for interest rates on hold. I think, yeah, it's just starting to annoy the electorate now because people are feeling this in rental affordability. You sent me a Sydney Morning Herald article where teachers just can't seem to find affordable properties to rent close to where they need to be. So, yeah, I think it's, yes, we've got big immigration numbers. We're not really building enough. But it's starting, people are starting to feel it on the ground now, and it's becoming a political challenge for the government. There was one other sort of piece of news this week, unrealised gains on superannuation. There was a lot of debate about whether Labor could actually tax unrealised gains in super. It looks like they're backtracking on that and instead introducing a $10 million cap. So some implications there for the wealthier people in their superannuation. But yeah, I think, the big sort of question over the next 5 years is what happens with immigration and what happens to housing supply? Because at the moment, there's that enormous mismatch.
Yeah, I think the super story is quite a big one. I think we should talk about that one next week, Pete, because I think there's still a few things to iron out that, but I think they have backed down. It was a pretty brave policy, to be honest. And the financial advice industry rightly was probably up in arms because it didn't really make sense the way that they were doing it. The thoughts about taxing more bigger balance in super make sense, I feel, and they weren't against that, but they were just the mechanics on how they were doing it, particularly unrealized gains and no indexing just didn't feel fair. And so they've backed down on those things. And but they have increased taxes for $3 and $10 million portfolios much higher. And I think that makes sense, but they're not sure how capital gains tax is going to work yet. And so I think it's an interesting topic, that one, because it was going to encourage people to sort of move money out of super. Now, if you're a bit gung-ho, and even though it hadn't gone through Parliament when sold all your assets and got money out of super, you're going to be regretting it. So that was often what a lot of people thought was going to happen. But you're careful what, I guess taking action before legislation's actually gone through would be my point on this one. What's your thoughts on New Zealand dropping the cash rate again? I mean, they're down to 2.5%, 3% of cuts down there. Why have they been so much stronger over the ditch than we are here?
Well, the higher interest rates have really impacted. I think as well, a lot has happened in the housing market in New Zealand to the extent that the RBNZ is also easing LVR restrictions. So I think I wouldn't say it's panic stations, but the economy's kind of ground to a halt in New Zealand. The housing market's taken quite a sizable hit. Actually, a lot of the Stats NZ figures show that about 0.6% of the Kiwi population per annum is now going to Australia for better employment prospects and higher wages. So yeah, they're kind of stemming the bleeding a little bit by cutting interest rates. So it's interesting, isn't it? Because if you look at Canada, they've experienced similar challenges. Housing markets on the way down, immigration's dried up really. New Zealand very similar, and yet Australia we just kind of kept on going. I suppose the government has come under a lot of criticism for high rates of spending, but in a sense, that's what's kept our unemployment rate so low and kept the economy fizzing along. So I guess there's always two sides to that story. So yeah, New Zealand, a few challenges there, but maybe those lower interest rates will start to bite. Right, we better get through our top 3 news stories of the week as time's getting on. So first story, which was covered in Macro Business and also the Australian Financial Review, is the 40-year mortgage a route to wealth or a debt trap? So we are starting to see a few 40-year mortgages in Australia. So I think with a longer loan term, it might potentially mean smaller repayments each month. But then obviously you're going to pay back over time more interest over the life of the loan. I suppose so there's going to be pros and cons. Chris, you're a mortgages expert. If you go down this route and take out a 40-year mortgage, does that have some impacts on your serviceability in the same way that an interest-only loan might do? And do you ever sort of get clients wanting a 40-year loan? I guess as somebody who in the sort of not too distant future, we'll be heading towards about 50s. I'm starting to think, well, a 40-year loan is actually too long. So I guess there's a few different things to think about if you were thinking of taking that longer loan term.
Look, it's. I guess the saying, "Hate the system," don't hate the player, hate the system, right? And I think this is a symptom of basically of the system. I'm trying to get my words out here, Pete. So basically, it's just the next evolution in trying to basically allow new buyers to be able to afford current prices. And one of the ways to do that is to allow them to pay the loan off over the longer term. Um, and I think this is when we've spoken about this for at least a year, I reckon. I was saying, look, 40-year loans are going to come. You can just see that it's just the next evolution. I think interest-only loans are going to come back in full force. They had to get rid of interest-only loans and off owner-occupier loans because it was a bit of a risk in our system back in 2015. You can just type in AFG index home loans, and you can basically go back and see the proportion of interest-only lending back in 2015. And some of the banks, i.e. Westpac, had a huge exposure to interest-only loans back then because they were offering 15-year interest-only terms on homes. And so basically, what they had to do is come in really hard. They penalised homeowners with higher interest-only rates, basically to bring a bit more stability into our banking system and protect the banks a bit. Now, when you look at it, $2.5 trillion of home loans on a almost $12 trillion property market, I don't think they're as concerned as they were. And the proportion of interest-only lending has been very little all the way back since, 2016, 2017 or something like that. So, yeah, I reckon interest-only loans are going to start coming back. Well, we're talking 40-year mortgages here. What's the consequence of a 40-year mortgage? Obviously, if you take 40 years to pay it off, you're going to pay a lot more interest than if it was over 30 years or 20 years. But just because you take out a 40-year mortgage doesn't mean it's going to take you 40 years to pay it off. The minimum repayment is the minimum, and obviously if you can afford more than that, you would just put the money either into the loan or into the offset account, and you would try to pay it off on your terms. A lot of people would argue, though, if you have a minimum repayment, people will just lifestyle creep, the hedonic treadmill. You'll just spend more if you've got more in your pocket, and the banks will win. But I think a lot of the next generations, unfortunately, will be buying properties and holding debt all the way through to retirement, and then will be forced to downsize at retirement because they've still got home debt on their home versus a house paid off. I just think this is the problems with buying a property later in life. You're not a 25-year-old buying your first home. You're getting there at 40. And then also the challenges of the cost to purchase, plus you're not getting on top of your mortgage because you've got to get your kids through school and then you get to the 50s and you can't really get on top of your mortgage. I think what you'll find is in 20, 30 year times, a lot more people are going to retirement with debt and they're getting rid of that debt either with using their super or just selling the property. And so, yeah, and you know what, to be honest, most people are getting 40-year loans now anyway. That's often a not spoken about enough. If a client comes to us and they bought their first home, say 5 years ago, and they would have taken out a 30-year loan, that property's gone up. Now they've got a smaller loan. We would then refinance that loan and we would put it back on a 30-year mortgage. The reason is it's less commitment to them and they just keep paying off on their terms. So most people are getting 40-year mortgages anyway because every time they refinance, they go reset it back to a 30-year mortgage. And that's just the reality of the way it works today.
The interest-only loans point is an interesting one because back at the peak of the interest-only frenzy about a decade ago, it was almost 40% of mortgages by value were on interest-only terms, including a lot of home buyers or homeowners. And then APRA absolutely smashed that. Now it's about 12%. But I did see just in recent times, there's been a bit of chat about, well, if investor lending takes off, we could reintroduce macro-prudential measures to punish investor loans and interest-only loans again, even though now it's only about 12% of the mortgage book by value is on interest-only. It's an enormous decline. I'm pretty sure banks would be keen to lend a bit more on interest-only, though, if they're allowed to. So let's look at the second story of the week. The real estate carry trade is a death star. So this is Martin North, Digital Finance Analytics, with John Wright, his guest this week. They must use AI to create these titles. That's brilliant. A Death Star. So I think, I suppose in short, what the thesis here is property holding costs are greater than income for investors, and there's a lot of household leverage or debt in the system, and therefore the housing market must inevitably collapse. So I suppose my question is here, is it a bubble or a cycle? Because in 2006, I remember a very similar debate going on, because at the time, an investor on a unit, for example, might get a rental yield of, let's say, 5%. But at one stage, mortgage rates were near a 9%, and there was a huge negative carry for investors. But we did have a massive housing shortage. Well, it seems to me that we're back in a very similar situation now. Rental yield might be, let's say, 3 or 4% for an investor, but you might have a mortgage rate of 6%. So same dynamic applies. You've got across the system, you've really got what they would call a negative carry or a negative cash flow. And I suppose that the theory here is that if it's like Minsky economics, you're creating a Minsky moment where the rents don't cover the mortgage payments and the other holding costs, and therefore everybody rushes to the exit and it creates a crash. And yeah, that's not really what seems to be happening. We seem to have more investors coming into the market in anticipation of the housing shortage. I suppose if you look back at what happened in 2006, obviously there was a recession internationally, which Australia by and large dodged. But what happened was interest rates went very quickly down towards 3% from previously a much higher level, above 7%. And I think as well, if we did get a sort of a deep recession, we'd probably see a rebalancing through the currency as well. The Aussie dollar would drop. So I'm not saying that there won't be a downturn. There will at some point, but whether or not it's kind of a Death Star is a different debate. Yeah, what do you think, Chris? It's obviously a key issue in the market that a lot of investors can't get income to cover the holding costs, and therefore they're negatively geared in the early years and sometimes maybe for a decade or more. So what do you reckon? Does that create a Minsky moment, or are we in more of a cycle?
Look, Martin North and I are actually friends. I've been going on his show pretty much every 2-3 months, I think, for 7-8 years. I remember going down to his house in Thurrool back when he was getting a lot of heat around a 40% market crash. So I was going into the bear den, I think you would call it, and he's got a very passionate YouTube community and Martin himself, we've interviewed him lots of times on The Elephant, sort of admits that he sort of got it wrong, which he sort of got to, right? He knows that he's been really thinking a crash is coming. And, but I sort of put him on the spot with it. Basically what he admits is he just didn't realize the amount of conflicts in the system and how the government would do everything it can to keep the system going. Because every time he thinks that, something bad's going to happen, someone steps in to protect the housing market. It's like the sacred lamb that you cannot ever stuff around with. And so, John Wright's obviously going to be great, for his community and talking up there to collapse. But it's a funny one, right? Like you could say that around lots of things right now. You could say that around Bitcoin. You could say that around, look at the price of that. You could say, look at the shares. I think Simon Mahaney, I can't say his name, but he basically runs Alan Gray. I really rate Alan Gray as investors, by the way. They're sort of counter-cyclical, sort of, what's the word?
Contrarian.
Contrarian, sorry, yeah. I was thinking, and I actually walked past him when we were doing the hike in the Blue Mountains, and I was like, on the tip of my tongue, I went to stop him. I was like, oh God, he won't know who I am, and but I know who he is, and it would have been a bit weird, but because I wanted to chat to him because he's always got such an interesting mind. He's been in the AFR all this week, basically saying that, the momentum in the Australian shares and international shares, it just put them up to, valuations on forward price earnings of just very high levels. And so you could say the stock market's a pretty dangerous place to go in right now. Based on just long-term valuations, you could say gold right now. We've all seen the rush of, the images all over social media where people rushing for gold and lining up to get their hands on gold, and gold's at all-time highs. So, yeah, it's a funny one. It's not property, but, yes, there's a lot of equity in there and a lot of high valuations. But if there is a downturn, people don't just rush to the equities. It's one of those asset classes that you still have to live somewhere. Do you really want to sell your home and go into the rental market right now? I don't think so. And so I think, yes, you might see some investors bail. And I think there is a bit of an issue for the investors who have bought in the last few years, who have bought the momentum. I think in the more affordable parts of our, regional locations, I think they're in for a bit of a dangerous time. If there is a bit of a correction, I think you'll see a lot of investors bail, and you could see a repricing of properties based on what locals could afford. But until that sort of reckoning happens, you might find that they just, still hold their value. What's your take on it, Pete?
Well, I think if you look at what's happened in Canada and New Zealand, there comes a point where the market cycle peaks, and sometimes the way that this stuff comes out is through declines in real terms. If you actually account for inflation and nominal price drops, and then suddenly you get to these situations where in real terms prices are 20% off the highs. So I think that's often how these things play out. It's not always. People often talk about big drops in nominal prices, like happened in parts of the US in the global financial crisis. But often the way it seems to play out is that prices come off the highs a little bit, but then after inflation, they suddenly down 20% from the highs. So yeah, I don't know is the answer. I do think, yes, if there's a risk, I think at the moment the capital cities have just got such enormous shortages of housing, but a lot of regional markets, people have really piled in. I've seen some massive increases in prices, 50 to 100% since COVID, and some of that demand is driven by interstate buyers agents and speculative demand. So there's definitely some people flying naked out there. So there's I'm not disputing there are risks in the system, but I suppose the thesis here of John Wright is that there is no solution, and there has to be a massive crash. I tend towards the view that where possible, the Reserve Bank, APRA, the government, they tend to put in place measures when housing markets are in downturns to cushion the blow. And often when the downturn comes, it often comes out through inflation and declines in real terms rather than nominal. So we'll see how it plays out when the cycle does peak, but it feels like at the moment we're sort of in an upswing. So going to be some way off, I guess, before we find out. So let's wrap it up with the third story of the week, and then we'll do your listener Q&A at the end. 3 ways to future-proof your mortgage repayments. That's an article that was in Domain. So firstly, get the right loan in the first place. Think about getting a flexible offset account, the ability to redraw, and the option to make early repayments if desired. Secondly, consider home loan protection. And thirdly, keep a rainy day buffer. Chris, what sort of other tips or advice would you give to a borrower today? Do you, for example, if people have the option to make early repayments on a home loan, should they do that or build up a buffer in an offset account? What sort of strategies do you recommend to clients these days?
Oh, this is a funny one, right? There's brokers I know, and so it's nothing against them, but there's a lot of content going around offset accounts versus putting money into redraw, and some are putting their hands in this, they're staking the sand, say offset, 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 and some are saying redraw, redraw, redraw. And what I think it's missing is that, some people are going to be better off, forcing themselves to save, and some people are going to have, not sticky fingers, not be on the hedonic treadmill, be able to keep money in an offset account and not spend it. And I think it's just looking at you as an individual, being real with yourself and saying, hey, am I going to get on top of my mortgage, or am I just, if I have money in my bank account, am I going to spend it? If you are a type of person that's very good at, living more frugally, doesn't really get, shiny object syndrome and spending money, and, then you might say, well, I've already got my system in place. I'm not going to spend more money. I'm just going to put that money in the offset to build buffers. The irony is they're the ones who are going to least need the buffer, because they're probably the one who's least going to get themselves into trouble. The other one that is probably spending everything they've got, they probably the one have to force themselves, right? And so then they are probably better to put money into a redraw and pay their mortgage off as fast as possible to actually force them to save. It's one of the benefits of a mortgage that doesn't get spoken about enough. And like superannuation, automatically forces you to put money away from your retirement. So does as a mortgage. It sort of wants you to save for your future at the same time as well. And to sort of get ahead of it, I guess it's like really trying to get really good at your cash flow and managing your mortgage. And yes, you might pay off your mortgage through paying it off, but you might want to just have an emergency fund set up, maybe at an offset account that you can't see on your internet banking, that's really hard to transfer in and out of, but it's still offsetting your mortgage. And it's there if you absolutely need it, but getting access to it's quite hard because you have to go to the bank or something like that. So there's ways to sort of it's all about behavioral science and behavioral finance, I would say. But yeah, I mean, I think I think you do also really understand how much paying a little bit more pays off your mortgage faster. A lot of people don't understand that as well. So that also gives people the desire. If they see the benefit, well, I'll pay my mortgage off in 10 years earlier if I pay an extra $100 a week. Sometimes these are the conversations people need just to get on top of their mortgage.
Well, we had that when mortgage rates were 2%. People were saying, well, why bother paying it back? I'm like, well, yeah, but you've got to think about the life of the mortgage and the weighted average expected mortgage rate over the whole life of the mortgage. It's not going to be 2% forever. Not in Australia, because we don't have long 30-year fixed rate mortgages. So actually, if you can make accelerated repayments on a home loan, that's a good thing. And I think you're right. It's a case of know thyself. And I say that as somebody who's just gone through 2 or 3 significant refinancings. I know there's a massive risk of me spending that money. It's just, I like travel, and there's a risk that if money's there and it's available that it gets spent. So I'm trying to filter it into a renovation rather than spend it all on trips abroad. So let's do a couple of listener questions.
And the final point, which I forgot to say, Pete, around insurance. So obviously I've come from a financial advice background. We don't do financial advice now. I'm not a fan of any short-term income protection policies and any type of insurance that will protect your income for a short period. The reason is it's usually very expensive for them. And the benefit they offer is usually short-term, hence why it's short. The real risk when you have time off work isn't if you're off for 3 months because you break your ankle or that you've got an illness that you're back at work in 4 or 5 months. That's not great, yes, but you've got sick leave, maybe you've got more sick leave at work, and maybe you've got a bit of a buffer and you can use your annual leave, and, that's okay. The real issue is if you get a real medium to long-term illness. Now, I'm not up to date with I used to say it all the time, but I think as if you're off work for more than a year, and this could be completely wrong because I can't remember exactly what I used to say when I used to sell insurance, but I think it's if you're off work for more than a year, I think the average is 8 years off work. So the risk is if you're not back in work after a year, that you're going to be off work for a long time. Something serious is wrong. And that's the risk you need to prepare for. And so income protection that has a term all the way to retirement, I think it's mostly 65. I think they might even be offering up to 70 now. I haven't stayed up to date with all the latest insurance changes. That's what you want with income protection. And, you really just got to figure out, how do I get that potentially a little bit cheaper? Consider things like maybe a 90-day waiting period, versus a 30 days. That drops the cost a lot. Maybe you don't have agreed sort of premiums. Maybe you have to verify your income, maybe you don't go indexation. Like, there's just really get some good insurance advice. If you want to protect your income, don't go through a big, retail. Don't go and get personal insurance. I just think go get yourself fully assessed through a lender, through an insurer. You can obviously, they're protect, but unless you've got some health issues, you've got to be careful here and check with your super fund as well. So insurance is a big topic, but I don't like any type of short income replacement type insurance. I think is very expensive, and if you're going to insure yourself for the real risk, because if you don't go back to work long term.
Good advice. Thanks, Chris. All right, let's do a couple of your listener questions, then we'll finish up for the week. So firstly, from Coastal Karen, we own a house in a beachside suburb on the sunny coast that's just been proposed to be rezoned from low density to medium density. It's currently an investment, but I plan to live in it in the future. We were about to start a fairly major reno, about 500 to 600K next year. We're now not sure if it's smart to spend that money given the proposed rezoning changes, especially with potential changes to the area's character, like more traffic, privacy and security concerns. What does a change like this usually mean for homeowners? Is it generally viewed as a positive or a negative? Do you think it's wiser to hold off or go ahead and renovate as planned? So, well, I think if your property gets rezoned, your specific property gets rezoned from low density to medium, or potentially even higher density in some of the suburbs on the Sunshine Coast, then you can potentially see a value uplift on your land because there's more you can do with the property. But if it's the locality that's being rezoned, well, I spoke to Peter Tulip about this because we've talked about planning changes, and he said the stats seem to show that there's no detrimental impact from rezoning on houses in the locality. I suppose, though, you could argue over the longer term, there could be less scarcity in your property type and there might be less livability if there's more traffic. I mean, of course, a lot of people move to the sunny coast because they like the low density, easygoing nature of the area. So there is that to factor in. I think just on the renovation, I say this as somebody who's doing a renovation right now, is that almost every line item on my budget so far is going about double what I've budgeted. So you could certainly say I wasn't conservative enough on my numbers, but the reality is getting hold of tradies is tough. Materials are difficult to source at the moment, and the cost of almost everything seems to be much higher than I would have expected when I wrote the budget a year ago. So that's another thing to factor in. If your budget is 500 to 600, it could easily end up being a lot more. That's just a word of caution. But Chris, going back to the question, should they do the reno anyway, or should they wait and see?
Look, I think every suburb, even though there's rezoning, developers are going to get attracted to certain parts of a suburb first, where they're going to be able to sell the development much easier. A lot of people in the developments want that lock up and leave, but also the easy access to amenity and the beach and the shops. And that's part of the pitch, right? Like, you get to live in a brand new build in a great location with a lock up and leave. And so how close are you to where they're likely to build? If you're sort of far enough away, it's been rezoned, but you're quite protected. It's kind of going to be a nice, quieter pocket. Well, you're probably going to find more houses are going to get knocked down. And then more of those buyers who want that live close to the shops will want to live kind of where you are. And you'll probably find that the amenity in the area is better, right? Like, a lot of these apartments will get built. There'll be, new commercial downstairs, which might be new cafes and restaurants. And, you kind of argue, is that also going to make it, it's a bit more traffic, but doesn't make it even more desirable to live there. You can see, for example, in Sydney right now, in Bellevue Hill, right? So Double Bay's going through a renaissance, and there's lots of apartments, and even the Intercontinental, I think, is coming down. New apartments are going up there. Like, but together with that, you've got a lot more restaurants, a lot more lively, in Double Bay. That's actually made Rose Bay and Bellevue Hill more desirable to live in, because people can then just go down to the Double Bay for their restaurants, right? So I don't know. Like, I think in this situation, it's sort of similar. Like, if you're sort of far enough away from it, you don't have to deal with the day-to-day traffic. But if you're in the middle of it, I'd be really hesitant, because, you could easily find that, you've gone and got this beautiful renovated place, but people are like, I just want to be up the road in one of those other houses. And so this is one of the costs of zoning changes, is there's people who usually benefit a lot and get a lot of capital uplift, particularly the ones who amalgamate the best sites early when developers are still trying to lock in work. But I would say that it's always people who get hit in that world who are sort of the ones that don't get spoken about enough when the zoning changes has really affected them, because they're the properties that the developers don't want, and they're nowhere near as livable as they were prior to the density was getting built. But I think, that could be your situation, or may not be.
Yeah, good thoughts. You just reminded me of Sunday afternoons in the Golden Sheaf, Chris. The Great Barrier Reef. Those those days are long gone for me. But I think you're right. They can be more dynamism in a location through the rezoning, but you do get a lot of noise and disruption in the short term. So let's wrap up with one more question, then we'll finish for the week. From Shacket Potato: I've been investing in ETFs and individual stocks for a number of years with a portfolio value of 200k. In 12 months' time, I'll need to sell approximately 150 of the portfolio to help fund a new house build. If you were in this position, would you sell now to avoid the risk of a potential downturn and reduction of funds available, or sell at the last minute to allow compounding to continue? Capital gains are not an issue due to historic capital loss. Well, there's no right or wrong here. If it was me personally, I would take the money I need for the house build and stick it on term deposit. Maybe when I was younger, I would have taken a different view and I'd have been mucking around with margin loans and so on. But the reality is like nobody can predict what happens to a stock market in a 12-month time horizon. I think historically, yes, the market goes up more than it goes down and you'll get some dividend income. But in the short term, there's no way to predict it. And valuations are pretty high, as Chris said earlier on, and things could come down. And you can get 4% on a term deposit now. So if it was me, I would just do that. I would maybe leave the rest of your portfolio invested. But what would you do, Chris? I guess I'm showing my age now, thinking in a conservative manner. But what about you?
I mean, why do you need to sell the shares? I mean, have you got equity in your home? Can you not get access to finance? You've got a house. I mean, it sounds like you found a new house built, so maybe you just got some land. Could you, it makes sense to use cash for that rather than debt, because if it's a house you're going to live in, then you'd want to have that with a low non-deductible debt. And so then you might want to then re-borrow in time to buy the shares. Whether you should sell the shares now, sell the 12s in 12 months, it's like who knows? Like it's actually, financially what's going to be a better option depends on where the stock market is in 12 months time. Like
it's like a game of chicken.
Yeah. And at the moment you're very high. So no one knows that, right? So it's a question, no one's going to give you the answer to it. And whoever thinks they know, don't know, right? So I think that's the wrong question, and that's not me being trying to be me. It's just I just don't think you're going to get any answer. No one can ever tell you the answer to that, right? The reality is that you are taking risks when you're holding properties, and if you do want to sell and you're forced to sell at any time in the next, say, 3 to 5 years, you've just got to know that markets can move very fast. It doesn't take a rocket scientist to go back and look over stock markets and see how corrections happen in weeks, and they can happen 20 to 30%. In weeks, that you just don't want to have a major market correction due to whatever it is at a time when you have to sell. And so you're just like one of those games, you've ever watched The Price is Right, and that yiddle-ee, and he's climbing up the mountain, and you've got to sort of press the button before he falls off the edge of the mountain. And you just don't want to be doing that. You don't want to just press that button too late and he's already over that and the market's corrected. So yeah, it's gambling. It's gambling when you've got a time that you need to sell by. And at some point, you just got to sort of jump off that mountain and put the money in the bank and put in a term deposit or a cash, even a high interest short-term cash account, Pete. There's a lot of those going around that are probably offering pretty good rates, even comparable to term deposits. So yeah, hopefully that was an okay answer. Shuck it, potato.
Good stuff. Thanks, Chris. Well, thanks everyone for tuning in. Come and join us on the Rask Community Forum. That's community.rask.com.au. If you've got any questions on mortgages, give Chris a shout. The link's in the notes. And likewise, if you've got any property questions, always feel free to drop us a line. And do send in your questions as well, because we always try and cover 2 or 3 of those at the end of each 2 cents episode. So it's golf for me this weekend. Chris, what about yourself?
See my little niece, and that's all I'm looking forward to. I haven't had a night out with my wife actually on Friday night, date night, leaving the kids at grandma, so that should be fun. Not sure what we're going to do yet. I'll probably decide that at 3 o'clock on Friday afternoon. But
party time, look out.
Yeah, it's we'll go stay in Bondi for a night or something, somewhere a bit different. What are you up to, Pete? Just saying a bit of golf? Yeah,
just getting up to Noosa Springs, so pretty quiet one for me. So yeah, still searching for commercial properties. So it's not easy pickings at the moment. A lot of competition and not much stock. So yeah, we'll update you as we go along over the coming weeks. Thanks for tuning in, and we'll see you next time. Cheers.
Thanks, Pete.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.